Good morning, and we are half an hour away from the opening bell. Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Yvonne.
Our top stories this morning: caution in the markets as investors await a Fed decision and key inflation data. China's markets set to reopen after a long weekend that saw an 8% jump in domestic tourist spending.
Now we're looking at Apple suppliers, and a lot of the AI plays in focus at this point. This lukewarm reaction to Apple's long-awaited offerings, including a tie-up with ChatGPT.
Plus, a third foreign judge to leave Hong Kong's top court as another who's resigned to the city's rule of law has been, quote, profoundly compromised.
Right, we're looking at the agenda today. So to reopen, obviously, front and center. You have mainland China, Hong Kong, and also Taiwan coming back online today. You had this massive move up, the biggest move up in oil prices going back to Feb of this year, and we are continuing to see some upside there. So the Shanghai contract will be very much in focus on crude as well, energy stocks. Yvonne talked about this, and more on this in a moment, the tourism plays coming through out of the numbers coming out of CCTV, Apple and Apple suppliers in Taiwan. We have a John Lee briefing at some point this hour, and also at some point today, we'll be getting the renewed and the new thinking here out of private economists on where they think the Hong Kong economy will be by the end of this year. Shanghai crude on that very point, Yvonne, up 1.4% on this melt up in energy prices overnight.
Yeah, we have an OPEC Plus report coming out today, so certainly that's one to look ahead to for oil markets. But certainly when it comes to the approach to the open, we're not really seeing that much upside or downside here. There's when we're flat across 850 futures here. We're watching very closely, of course, this dollar, stronger moves continue, and really this relentless rally that you continue to see given the European elections fallout, the stronger data out of the U.S. So that is still lighting this dollar on fire here. We're at 726, close to 727 levels for dollar China. So still on the weaker side for the renminbi. You take a look at, broadly speaking, and how risk sentiment is looking like. There is still a bit of calm, leading up to this, what they're calling this double whammy, right, where traders are really bracing for more volatility this week when you have a Fed meeting and just a few hours before that U.S. inflation print, right? So certainly that's one thing to watch very closely. U.S. futures are still on the weaker end of things. We're watching those Euro futures. Looks to be seeing some green here this morning on the back of what we've been continuing to follow through, this follow that we're seeing in bond markets in Europe, which we'll get to in just a little bit. But first and foremost, you are seeing some upside in the Nikkei, the Kospi, Taipei. Obviously, we're watching those Apple suppliers very closely, just coming back from that holiday as well, and seeing a decent bid across those equities here this morning. And we're watching very closely also when it comes to the Mexican peso. So continue to see that spike higher, and then we paired off a little bit on the back of what the president was talking about when it came to reforms, and that it might not impact the currency. Certainly that does maybe lead to more risks here when it comes to that carry trade, that maybe we're not quite done yet when it comes to the volatility on that currency as well. We talked about the move in Brent crude. Yeah. We're seeing there, extending those gains here right now. Iron ore is up some 2%. Dollar yen's at 157 levels just days before that BOJ meeting as well. And we talk about those European bonds, and basically what you're seeing across the French-German bond spreads is basically blowing out, right? You take a look at where French 10-year yields are. We're back to those 2024 highs right now. So basically that spread between French and German bonds are about 8 basis points here right now. That's the widest we basically have seen in almost 2 years, and really brings us back to those levels that we saw the widest this year overall. So, this is another sort of hurdle that investors really have to deal with that we really didn't see coming, right? We thought it was just going to be about central banks, about inflation prints. Now there's also this drama that's bearing out. And it could be a big gamble as well for France, this election. Yeah, the early elections coming through there. So perhaps looking at Tuesday as well, to Yvonne's point, we are at least seeing some upside as it pertains to Bund and Oat futures, bottom of your screens, following the worst day this year so far as the oat contract is concerned. Right. Now, let's have a look at Apple suppliers. To Yvonne's point there, of course, we're unpacking whether or not it was was the street impressed by what Apple laid out there. Shares were down 2% at about the close here, of course, at Worldwide Developers Conference. Among the highlights include plans for AI features on iPhones, iPads, and Macs. It's also integrating ChatGPT into Siri. Let's listen into Apple CEO Tim Cook speaking at that presentation on the company's AI push and the reaction from Apple co-founder Steve Wozniak.
Recent developments in generative intelligence and large language models offer powerful capabilities that provide the opportunity to take the experience of using Apple products to new heights. Introducing Apple Intelligence, the new personal intelligence system that makes your most personal products even more useful and delightful.
You had a choice to circle some little area and let it go and do its magical wonders, or rewrite something, and you chose to do it, what it was supposed to do, and that means you're looking at the result and determining as a human, how does that make it work? So this is one more type of AI, Apple Intelligence. I have AI myself, actual intelligence.
Let's get more now from our Bloomberg Tech reporter, Mark Gurman. And Mark, I know you've been covering this all day. The market seems to be disappointed, I guess. Maybe no surprises from this unveiling from Apple. Did it win you over in any way?
There were certainly no surprises in this event, but Apple Intelligence is super interesting. What they've done here is created a suite of different AI features. They looked at every application, every feature, every element of the user interface and asked themselves, where can we apply AI? Now, this whole thing seems quite a bit rushed to me. They fell completely flat-footed when OpenAI and ChatGPT and Gemini hit the market nearly 2 years ago. And so this is their response. And it's quite interesting because the first initial beta version of the new iOS 18 that a lot of us have been playing with since their introduction earlier today is missing these features. So they're coming in quite hot. They're not going to be available for developers to test for quite some time. And even when it launches in September, it will be a beta. Better yet, a big slew of the features are not going to be rolled out until next year. That includes an optimized version of Siri with large language models. I think Apple did enough to show the industry, to show consumers, and to show Wall Street that they're here too with artificial intelligence. What they didn't do is leapfrog anyone, and they didn't bring anything new to the table. When Apple comes to new product categories late, they usually bring a new tech, they bring a new interface, they bring something new. The iPhone wasn't the first phone, famously, but it was the best one. Apple is not the best AI here. They are a laggard in this technology, but they're coming at it with a little bit of a different approach. That's the tight integration and privacy.
Mark, just your thoughts on, they may not have done enough on certain aspects. They did enough, though, to push the buttons of Elon Musk. Who essentially tweeted out the fact that if they were to go down this route specifically on the operating system, that he would need to ban iPhones. What do we know about that, and what do we understand about the issue?
I think Elon Musk has shown a bit of an ineptitude about some modern technologies. He's clearly a brilliant man who created many brilliant products, was obviously involved in PayPal and involved in Tesla. But he's a competitor to OpenAI and Apple at this point. He's trying to roll out his own XAI functionality. He wants to get his name out there in terms of artificial intelligence once he was involved with OpenAI. So it's no wonder that he's pushing back now that it has this 2 billion user base strong partnership with Apple. Now, he does make a good point. There are clear privacy implications with OpenAI. There's a question about how much of what an Apple device user is doing can be seen with OpenAI, from OpenAI. What is OpenAI doing with that data? How much can Apple track to see what OpenAI is doing with people's personal information? Now that it's integrated into iOS versus being a standalone ChatGPT app from the App Store, the stakes are a lot higher from Apple's privacy standpoint. So he makes a good point. But I think saying that he's going to have to put the phones in Faraday cages is a step too far. I think he's probably being sarcastic. He probably would need to ban every phone, whether it's an Android phone, a Chinese phone, or any type of phone, because they're all going to have OpenAI and different, privacy invading models on them. That's just the world we live in at this point with this new age generative AI.
Mark, fantastic stuff. As always, sir. Mark Gurman there, our Bloomberg Tech reporter. On the latest here, let's look at the market implications of AI and certainly the concentration we've seen in just a few names here. Let's bring in Helen Ju, our first guest this hour, Managing Director, CIO at NF Trinity. Good morning.
Morning, David. How are you?
I am not as good as this AI trade has been, which is very hard to beat. How are you looking at this now? Is everything in the price? Is it cheap? Is it too expensive? Where are you in this debate?
Look, I think the AI theme has certainly played out pretty well over the last few quarters, right? There is a lot of market euphoria, but I think there's going to be differentiated outcomes by company and by subsector. So on one hand, you have the names that have a lot of technology know-how and barriers, and NVIDIA's and so on. There's competition, but there's not going to be so much competition that it's going to really erode their market share meaningfully over the next couple of years. And then on the other hand, you've got stuff that has also run up quite a lot, but it's really still either to be proven whether there is any meaningful monetizable outlook in the next couple of years, or there is going to be significant amounts of competition that might emerge over the coming quarters. So I think those are the names that we actually have to watch out pretty closely for. So I think there's definitely going to be differentiation. There already has been in the market, and I think that's only going to show up more over the coming period.
It seems like the concentration has been focused on the hardware side of things, but people are looking at, how can this spread to more software, to even, when you take a look at AI PCs, for example, that's the sort of the next phase of this. Is that something that you can maybe look into, the next phase of this AI?
Exactly. I think people want to look at really at the very end, right, what are consumers and businesses going to be using, whether it's hardware, whether it's going to be software, whether they're willing to pay for it in the foreseeable term. I think that's the most important thing, right? Not just the potential adoption over the medium to longer term, but what's actually monetizable to really grow into the valuation expansion that we've already seen, even for companies where AI-related business is actually just single digit as a percentage of their revenue over the coming couple of years. So on hardware side, I think there is going to be, obviously you need to adopt the hardware in order to use it, but there's going to be a lot of competition in terms of AI server, AI PC, ODM, OEM. A lot of this stuff is going to be pretty crowded, and the entry barrier is not that high. On the software side, it really depends on what people think is going to be value added that they want to integrate into their daily lives, and that's still a question mark as well, right? Are people going to be using Copilot as quickly as what the market's expecting? Are people going to be using it on Siri? Are people going to be using, all sorts of new things that are being worked on, but yet to be proven? That's the thing to keep an eye on.
Should we expect this AI theme to continue to be the market driver, at least over the short term, at least?
It certainly has been the market driver so far, and that's actually a little bit unusual, right? So we have seen Magnificent Seven move up very meaningfully and lead the market, and a lot of that has actually been coming from the AI theme and the haves and have-nots within this overall AI realm. So I think the haves, the real haves over the coming few quarters, the ones that are proven to be able to deliver into the high expectations, they'll continue to do better, and the have-nots may face risks of more significant de-rating. Not necessarily that earnings are going to be cut, because earnings haven't really been revised up that much anyway, since the AI contribution isn't too big. But if they can't really deliver, you'll see derating, and that could actually drag on market sentiment overall as well.
We talk about this week of event risk, right, with the Fed CPI print coming through. I'm just wondering if we do see that change in the dots this week. Does it change anything for you on where this equity market and rally is going?
Look, I think nobody's expecting any kind of rate cut this year, this month out of the Fed, right? I mean, people are generally talking about late in the year, probably November or just a little bit before that. People are really going to be watching for Powell's comments and for the dot plot. But the dot plot is basically almost going to be like a mark-to-market, right? I mean, the market's basically at 1 to 2 cuts, and the dot plot's at 3. Yeah. So if the dot plot doesn't move at all, that would actually be a little bit unusual and unexpected, but will it actually move to 1, or is it more likely to stay at 2? And more importantly, is there going to be any meaningful changes for the end of 2025 dot plot? Yeah. Right now, actually, the market pricing versus the dot plot are in the same place for end of 2025. So is it just that end of 2025 stays the same, and actually it just gets pushed back a little bit, maybe 1 or maybe even, 2 cuts pushed into 2025, or is there going to be a move into the late 2025 dot plot as well? So I think it's something to watch, but it's not going to be as dramatic as some of the other Fed meetings that we've had in the past.
All right. Helen, we'll have more from you. Helen Zhu, their Managing Director and CIO at Trinity. We're counting down the opens of trade. Of course, it reopens in Shanghai, Shenzhen, and Hong Kong here today. It looks like pretty slow going so far, just what futures are pointing to, but we'll see how things go here. This is the China Show. All right, that renminbi fix just crossing your Bloomberg here. So it's around the 711.35 levels here this morning. So we continue to see that weakness, though, being tracked when it comes to the yuan. We're hitting around those 726, 727 levels, of course, on the back of this resurgence in the dollar in the last few sessions or so, Dave.
Yeah, really from Friday, right? From the jobs report into today. So I think the open on the onshore rate is going to be interesting. Certainly when you look at the move in the euro, for example, it took out all three moving averages from Friday into the weakness we're seeing now. That takes us into the event risk this week that we've been highlighting. So you have CPI, a few hours after that, you have the Fed decision coming out as well. So JPMorgan, among the many banks, including Citi, and we have a piece on both, on the Bloomberg, gaming out these scenarios. I won't take you through the different numbers, but effectively, in terms of probability, maybe a higher possibility we'll get a reaction across these markets. I think when you look at Citi's own modeling, they're expecting perhaps the biggest move or reaction in the stock market going back to March 2023. So go back about 15 months or so. So it's going to be eventful, depending on, of course, on what CPI comes out in, and, of course, what the Fed eventually says, and, of course, a press briefing, and what the dots eventually show us, of course, Yvonne. And
it's not just what the US CPI is going to say, right? I mean, what Powell's going to say in that press conference, I think Citi was the one that said it, that might reverse some of the moves that we're hearing from this data print as well. So it's basically these two blows to the markets that, really we're bracing for here right now. Helen Ju is still here with us, Managing Director and CIO at NF Trinity. We talked a little bit more about the previous side of things of whether the dots are going to shift. Our question of the day today asks really if we actually see the dots lean a bit more hawkish right now, maybe even talk about one rate cut this year. What asset class do you think would be most at risk right now?
Well, look, I think the chance is pretty high that the dot plot median will shift towards 2 cuts this year from 3. If it shifts to 1, it's not a huge deviation from what the market's already pricing in at the moment, but it does look a little bit more hawkish. I would say probably the most directly impacted and most sensitive is going to be obviously on the fixed income front for the U.S. specifically. And within that, one would think that Treasury is sensitive, but I actually think that probably IG bonds potentially, just because, one, obviously it's also sensitive to any Treasury yield moves, but also to just the credit spread right now is extremely thin. So the credit spread is basically telling you that people think that there is literally nothing wrong with the U.S. economy at all. It's really a Goldilocks scenario. We're talking about credit spreads that we haven't seen since basically 2021 when, money was flowing amply everywhere. So if there is signs that inflation is really potentially quite out of control and people really worry about the CPI print and thinks that the Fed also agrees that they share this concern that CPI is not going to be contained easily, I would probably say that IG bonds might be the most at risk, at least from a direct perspective. Obviously, dollar might strengthen a little bit as well, and that will also impact some other assets, but that would be more indirect implications.
We've had a few people come on and talk about how the credit spread and how tight it is a good leading indicator of the equity market. Do you think that's still an accurate gauge of the equity market, and also separately where you look at the VIX, for example, and how it's non-existent really? Do you think that's also an accurate gauge of the hedges right now and the health of the market?
We think that the equity market in the U.S. is quite buoyant as well, and already also pricing in pretty much no landing and a very much Goldilocks scenario. If you look at valuations on an average basis, it's definitely at the higher end of the range. If you actually look at fixed income, obviously it's pricing in quite a lot as well. So both of them are relatively stretched. We actually think that probably the best trade going into all of this is basically to hedge a little bit more, right? I mean, as you mentioned, VIX is extremely low. VIX is at 12 right now. Yeah. It's very, very cheap to hedge away and, hold on to some of the gains that you've made year to date. And we actually also think that buying some CDS on IG bonds is not a bad idea either, given where the credit spread is at the moment. So those are two of the trades that we think are, pretty much no-brainers at this point in time.
So we have some guests talk about just overall the macro picture is actually looking pretty decent right now, particularly the global PMIs, for example. China growth, I think, looking a little bit better. I mean, is that enough to kind of overshadow this resilience in the U.S. markets and this whole AI trade in some ways?
I do think it's a huge positive that global PMIs are starting to pick up off a very, very low base, right? Yeah. But you have to keep in mind that's driving other economies more than it's driving the U.S. The U.S. has actually been very much dependent on consumption and services. That's really the engine behind the U.S.'s growth, right? Whereas Europe, Asia, and rest of the world is more dependent on PMIs and manufacturing and exports and traditional industries. So the U.S. rally has really been the strength of the consumer, and the strength of the consumer was helped by the buoyant asset prices and the buoyant property market and all of these virtuous feedback loops that were rolling together post-COVID that we still are enjoying, whereas everywhere else, we've actually unwound a lot of the post-COVID policy boosts. So I think we have to watch the U.S. consumer very closely. We've already seen some signs of cracks, especially in the lower end side of the consumer. If that continues to get worse, or if unemployment numbers or jobs numbers have, a slight big negative surprise, I think that's actually going to make the U.S. market, whether it's equities or IG, quite fragile. So that's probably a little bit different from the global PMI cycle.
And could China be an alternative at that point in time? Yeah. Of course, more with Helen Ju on the China side of the equation here in a moment. Managing Director there, CIO at Trinity. Going into the open today, reopen, we're down 1.1% in the early goings on the Hang Seng Index. Also, a bit of weakness coming through in the contract over in Singapore. Nothing much happening on the long end of your CGB curve. In fact, we have a story on that too on your Bloomberg if you're interested in going into this rabbit hole, how things have effectively frozen at that part of the curve. Plenty more ahead. This is Bloomberg. All right, we're going into the Tuesday session. It does feel like Monday, though, looking at the direction of travel. Sharply lower, 1.3% led by tech. We are slightly on the weaker side on the currency. Certainly, it's the onshore rate you'll want to be paying more attention to at the open in about a couple of minutes from now.
Yep, in terms of stocks to watch here today, we're watching energy stocks, just given the move that we saw in oil and that sort of pop that we saw. Not quite seeing that reaction in some of these energy shares. We're also watching some of these gold miners as well. It seems like the PBOC tapping the brakes on gold buying. So certainly that's one central bank maybe that's really kind of reversing the sort of trend that we've seen from global central banks. We're still hovering on 2,300 though for gold of late. But yeah, Shandong and Zijin Mining both down substantially here today. Travel stocks as well. We talked about the data that we got over the long weekend from CCTV, talking about an 8% growth in terms of domestic tourism spending. Citi, though, is saying that it's actually pretty weak, according to Terra's, in terms of travel demand during the Dragon Boat Festival. So we're not seeing a big reaction, really, from these travel stocks so far. Yep. Okay, let's go into the open right now, just under 4 minutes away. And, yeah, I mean, we're light as far as data. And then we talk about inflation, which should be out tomorrow, I believe. Yeah, inflation numbers are coming through tomorrow. The open, Tuesday open, is 3 minutes away, and we are pointing lower ahead of that opening bell. Plenty more ahead, including the open, obviously. This is the China Show. Welcome back. You're watching the China Show. It's the reopen after that 3-day holiday coming through from Hong Kong as well as in China here. And it looks like we're coming back a little slightly on the back foot there. 1% losses for the Hang Seng here already. Futures are still pointing a bit lower, and we are still dealing with a little bit of a weaker renminbi right now. We talked about that domestic spending data, which looked okay, but maybe not enough to kind of turn around some of these tourism stocks here today as well. We talked about, we still have inflation numbers out of China tomorrow as well. So not a whole lot really in terms of catalyst here this morning, Dave. No, certainly not a lot of positive policy pronouncements during the holidays, and certainly ahead of the event risk, and including, you mentioned China inflation, U.S. inflation, and the Fed. Certainly I guess the temptation is to take money off the table for now. And all that being said as well, with the exception of Japan yesterday, Asia did have a down day as well. So just keep that in mind. As it pertains, though, to mainland markets, I mean, it depends really what index you're looking at. Multi-week skid, this downtrend that's not so pronounced, but it's been consistent. Shanghai comps are down about 4 straight weeks. CSI 300 is down about 3. In fact, I'll show you a chart in a moment here, the CSI 300. CATL, Yvonne might have more information on this one. Now, buy the dip, I believe is what they're saying, following that dip that we had on Friday. So there's a further dip. Buy it if you want to. And some of the big plays as well. Here we go.
So Shanghai crude, 3%, play catch-up on this massive move up in global oil prices. Watch it very, very closely. And in case you missed it as well, there's some news out of the China foreign ministers meeting in Russia. There we go, reiterating their strategic ties between the two. Okay. Flip the boards and have a look at where we are in Hong Kong. Early goings indicated that the pressure will be coming from the tech and growth space, and that's likely what we're seeing, 1.2%, Tencent, as you can see, 1.2. We're also looking at some of the, I guess, more consumer-focused mobility sort of names, given all the sort of travel data that's come through out of CCTV, down 9 cents of 1%. John Lee, by the way, is set to speak at some point over the next 30 minutes or so. It's a weekly press briefing from the chief executive's office. And speaking of travel, flipped boards, we're also looking at energy because of the oil price that we had earlier on, and also gold. So PetroChina, there we go, moving the opposite direction, and also CNOOC, and some weakness coming through as far as the travel numbers are concerned. As promised, here's your chart, CSI 300s. We took out the 3,600 level. That's a sort of week-old story. We then took out this key moving average. We closed below that for the first time in several days after testing that for many, many sessions. And we bounced off your 200-day moving average, which is, I guess, the one to watch as we move into today. At these levels right now, you just draw a straight line. We're back to the levels of late April on the onshore market, Yvonne. So, yeah, so in many ways, we've not come full circle, but we've seen really weakness come through over the last 3 weeks.
Yeah, the consolidation side of things. And I think at this point, investors are just looking for some sort of implementation now. How sustainable is a sort of rally if we're not going to see some of these reforms? I said that R word come through here as well. That brings me back to Helen Ju, Managing Director and CIO at NF Trinity. She's still with us. You talked about last year, right? The Ds, deflation, deleveraging, derating. You said this year's really going to be about those Rs, reflation,
recovery,
re-rating.
Well,
where
these other 3 Rs can hopefully lead to their re-rating, right?
Yeah.
We've already seen a degree of re-rating year to date, right? I mean, I think everybody's been pleasantly surprised that China is no longer underperforming. The H-share index is basically up as much, if not slightly more, versus the U.S., versus Europe, et cetera. And that's really just off the back of a little bit of economic recovery, nothing really major, more like an L-shaped landing rather than a V-shaped recovery. A lot of cyclically supportive policies have come out recently in terms of property, in terms of upgrading your cars to EVs, in terms of consumption, a little bit on the reform side in terms of MOF issuing super long-term bonds to try to fix the local government finances, but nothing major yet, right?
Yeah.
But because of the very low positioning and valuation, the market's already popped quite a good amount year to date.
How much more underweight do you think investors are at this point? So that underweight has reduced a little bit, but still massively, you think?
Still massively for foreign investors. I don't think that there's been much foreign participation at all, if any, so far. Maybe a little bit in terms of fast money hedge funds, but nothing on the long-only side. Right. Most of this rally has been really driven by the southbound stock connect, and I don't think that foreigners have gain conviction at all. I think if we look forward, there's a couple of things that need to happen. Cyclically, you need to see things continue to improve just mildly. And if the U.S. or elsewhere starts to weaken a little bit and people start to think, it's not a one-way trade anymore for the S&P or for the AI theme, then maybe there's more interest to seek non-US dollar assets elsewhere. That would help. But I think the most important thing in terms of this re-rating potential is not only a little bit of reflation to come in the second half of the year, and the base effects will be a lot easier as well, but most importantly, whether there's any meaningful sign of significant reform agenda. And there, I think the expectation is very, very low as well.
And what are investors waiting to maybe pick up once that reflation happens, right? Is it still going to be tech, property, dividend stocks that really have been the outperformers in this rally so far, or are they looking at other things?
I think there could be other things as well, right? So maybe the first impacted group is basically the direct beneficiaries. So, for example, reducing the taxes on the withholding taxes on dividend stocks through the Stock Connect. I think that's what really triggered. People are hoping that there is going to be more payout increases coming out of the SOEs, and maybe greater emphasis, like the Japanese and Korean companies, on ROE rather than just growth itself. So I think that would all certainly help. But the second second order of benefit or a second degree of benefit would actually come from the consumption side, right? If all this stuff is starting to work, are you going to start to see, let's say, online GMVs go from mid-single-digit growth to maybe high single-digit growth? Are the companies going to be able to deliver a little bit of growth versus no growth or even declines? Whether you're in a declining state as a company versus a no growth state versus a slight growth state, that means entirely different valuation multiples that the market's willing to pay. So I think that's probably going to be the key catalyst. Banks, telcos, energy, these are the sectors that have performed very well already over the last 6 to 12 months, certainly outperformed a lot on this dividend theme. I think that can still continue because the yield is still decent, right? Like 7%, somewhere thereabouts. Right. Certainly better than what you can get elsewhere. But I think the next leg, if there is a market rally, will come from stuff that's a little bit more consumption oriented, that's been beaten down, and maybe a little bit more cyclical as well.
Yeah, you bring up an interesting point on this value up program and the reforms in the SOEs. In fact, Shuli Ren, I'll bring you in right now, of course, our Bloomberg Opinion column. You wrote about this, and you've compared the efforts that China's putting in place and the efforts that the Koreans are also putting in place as well. And you think China's in a better place to get the needle moving and not so much Korea.
Yes, I think it's basically carrot and stick. I mean, we all know, basically like what Helen was saying, the Chinese government is trying to do state-owned enterprise reform and then get the SOE companies to pay out more dividends, right? And then this year, they start to make senior management's performance based on the stock market performance. And we know, if you look at President Xi Jinping's anti-corruption campaign, right, the range of the anti-corruption is expanding all the way to dereliction of duty. Basically, if you don't do your job, you're corrupt. So that's the stick. And on the carrot side, we do see that the stock market investors, they have been rewarding companies that are on the verge of these SOE reforms, right? So that gives senior management some more incentive to actually deliver and say, okay, I am paying you dividend and you are going to reward me with better jobs and whatever. But in South Korea, what they're doing is they're trying to follow Japan's this shame index, which was launched a decade ago. And 2 weeks ago, the South Korea's stock exchange, they had a voluntary disclosure program, basically saying companies need to show how to improve their valuation. And only 3 companies have participated in 2 weeks. So there's nothing.
If you look at the 10-year horizon, though, I mean, Japan, Taiwan, that's rewarded stock investors quite well. China and Korea has sort of been in a slump or so. These economies are quite similar. Excuse me. Why do you think there is that divergence then?
I think stock market a lot of times has more to do with the economy. Economy matters. Let me put it this way: economy matters, but stock market is more than that. I mean, like we all know, China and Korea's companies have been treating minority shareholders like basically doormats, right? SOE banks, they are regularly asked to do national service, right? Bailing out small banks, refinancing developer loans, even though we know the real estate is not doing well at all. And then these days, funding China's chip ambition. In South Korea, those chaebols, they basically use all sorts of business affiliates to buy mistresses' apartments. To do all sorts of stuff, right? Like we just know, minority shareholders are doormats, and people over time they just lose interest.
Yeah. So it's minority shareholders, mistresses, and then major shareholders, isn't it?
Absolutely.
A question for both of you. Shuli, I'll ask you the question first, and I want to get your thoughts, Helen, too. So we know if you went long on China SOEs, you've done very well this year. If you've done long on high dividend stock, you've done well this year. How easy, though, is that to sell to the foreign long-only funds to gain exposure to China SOEs? Your thoughts on that?
I think it would be a little bit difficult. It depends on what kind of foreign funds they are. Like if you are like a more ideologically flexible, and then you will say, okay, I will align my interests with the majority shareholder, in this case, the Chinese government, maybe. But for certain funds that are more into ESG, perhaps it's difficult.
Well, David, you got to remember that basically oil stocks, telco stocks have been banned from U.S. ownership since Trump time. So basically, by definition, those names are no longer in the relevant MSCI indices. And therefore, that's another reason why we think that there's been very limited participation and benefiting from this trend recently. The banks are still in, but as you know, the foreigners tend to be very skeptical regarding China's overall financial system and therefore historically have not really favored the banks. So I think in order for them to benefit, you need to start to see other sectors start to move, like I talked about, like internet, consumption, and maybe some of the cyclical and industrial sectors within the A-share market for the first time in a number of years. That would actually get people, I think, a bit more interested. One of the overhangs, though, is still the election, because a lot of those industrials and exporters are potentially subject to Trump tariffs or export bans, et cetera. So that's actually been an overhang in terms of sentiment. But perhaps after the election, he'll be more practical and maybe not necessarily do all of the extremely hawkish things that he talked about. If that happens, that could actually be an upside surprise that could catalyze performance going into next year.
In terms of just other upside surprises, what do you think about for the third plenum and what to expect from that meeting?
Well, the third plenum has been delayed for a very long time, and as a result, the expectations has basically sunk into zero. So I do think that there is more upside surprise potential for the third plenum, whether it's some of these SOE reforms or maybe capital market reforms, right? Maybe reducing the threshold upon which, people can be eligible to participate in Stock Connect. Maybe it's Insurance Connect. Maybe it's some of this innovation that we haven't seen so far. There is also potential for things like HUCO, like consumption-related reforms, like rural land reforms to allow farmers to better monetize what the assets they already have, maybe fiscal and tax reforms, local government financing reforms. There's actually a pretty long list, and if any of this stuff comes through, which is not expected at the moment, I think it's going to be much more meaningful for the market performance versus, let's say, just another rate cut or just another RR cut. Those things I don't think are going to really matter anymore.
All right, Helen, thanks so much for joining us. Helen Zhu there, Managing Director and CIO at NF Trinity. Also, our thanks to Shuli Ren, our Bloomberg Opinion columnist. We got plenty more ahead. This is Bloomberg. All right, taking a look when it comes to crypto markets here this morning, we're still seeing a little bit of a back foot here, just given the event risk out there. And really, we're not seeing a whole lot of risk put on the table here ahead, of course, the Fed and that US CPI print as well. And certainly the threat of maybe those dots being moved maybe lower is certainly one thing that people are dealing with here today. So Bitcoin, we were talking about 70,000, maybe even getting to records. We come off that now, sub 70. Ether also just around that 3,600 level mark here today.
Yeah, well, a veteran of the crypto sector thinks that when you look at price right now, we're in extremely early innings of a multi-year bull market when you look at adoption so far. We talked about that. We talked about her warning that funds, focus on digital assets are still really at the beginning of their specific development journey. Certainly a long way to go until this global adoption theme really becomes very dominant. So I'm talking about Ophelia Snyder. We spoke exclusively to her and my colleague, of course, Rebecca Sin, in this week's episode of the Tiger Money podcast. Have a look.
I think the friction's going down. I think the understanding's going up. And I think the realization that these assets are here to stay, people are using them, people care about them, that's not going to change. And I think one of the so I have a very weird little claim to fame, which is that my mom is the one who actually introduced me to crypto in 2013. Usually that interaction goes the other way. And the reason my mom introduced me to crypto is because we were watching a documentary about something, and she told me, Merck spends too much money hedging, globalization is here to stay, but geopolitical stability at this level and everybody getting along on every topic is a historical anomaly. That is not a stable status quo. That's not the way the world works. So how do we keep the benefits of globalization and global trade without a structured monetary system that everybody can participate in? We need one. That makes sense. We should have that. Have you heard of a thing called Bitcoin? And I'm like, no, I have no idea what you're talking about. And we've gone a very long way from that, from it being this concept of people who have that kind of vision and understanding to really this being part of everyday dialogue.
Yeah, I think before Rebecca steps in, I just have a follow-up there. So how long after or how soon after did your mom eventually pull the trigger and buy her first Bitcoin?
My mom bought her first Bitcoin when there were products that would allow her to do so. And it took a few years. And she missed out on quite a hefty return as a result of that, because the infrastructure wasn't meant for her.
Yeah, she's okay now.
Yeah, she's okay now.
Okay.
And actually, it's funny. She's the one who inspired me to build the whole company. Me and my co-founder built this company for our moms who wanted to build products that they would feel comfortable with and feel good about. So that's actually why 21 Shares exists in the first place.
So what level do you think Bitcoin will end at this year, 5 years, 10 years? Moving on to the fun stuff now.
My view is we're so early in the adoption cycle. There's essentially no intermediaries in the space. There's no solicited demand. Everything is unsolicited today. You are missing still accessibility for a few key geographies. You're missing accessibility on a few key platforms still today. It's just so early. And if you go back, I think, and it's also very early in the impact of the halving. The impact of the halving is similar to a rate cut or a rate increase in a regular economy. It takes a while for those things to be reflected. So I think we're still quite early in this market cycle and have a ways to go.
That was 21 Shares co-founder Ophelia Snyder speaking to our Tiger Money podcast. You can catch that full conversation today with new episodes every second Tuesday on Bloomberg.com, Apple Podcasts, and Spotify. We got plenty more ahead. This is Bloomberg. Here are some big corporate stories we're following today. OpenAI has named Sarah Friar as its first chief financial officer. Friar is the former chief executive of neighborhood social networking service Nextdoor Holdings. The ChatGPT maker also appointed Kevin Weil as its chief product officer, and Weil previously steered product development at Instagram and Twitter. Kansai Electric Power is playing what would be Japan's second transition bond to finance nuclear power projects. SMBC Nikko Securities, one of the underwriters for the deal, says Kansai is planning to sell over $190 million worth of transition notes in 2 tranches in July. The company is planning to use the funds to invest in its carbon-neutral projects. And the world's largest vaccine maker says it's ramping up its production capacity as it expects demand for inoculations to surge, especially against malaria and cervical cancer. Serum Institute of India CEO Adar Poonawalla says it will take about 2 years for demand for malaria shots to meet supply. Poonawalla spoke exclusively with Helen for an upcoming episode of Latitude.
I think we'll probably double our capacity over the next 5 years. So we're selling around 1.5 billion doses of vaccines at the moment. I think that could easily reach 3 billion doses in the next 5 years. It's just that what I meant by that is it's not a linear growth. So some years, if there aren't many catch-up campaigns or outbreaks, then you don't, grow that much. But then suddenly there'll be an outbreak in certain areas, or there'll be a new vaccine that's launched. And a budget is approved for that.
And you can hear more from Poonawalla and other newsmakers from across Asia on Latitude, of course, with our colleague Helen. That other episode, of course, dropping there as well. Right, just a brief look at markets right now. Okay, there's lots of news coming through. Yeah, we thought it was quiet, so maybe let's start off with some of the chick plays right now. So Taiwan, just keep in mind, was shut yesterday, so there is an element of catch-up here. There's also the story, of course, of NVIDIA pushing higher. And if you're curious, by the way, if you look at your screens, NVIDIA has a different price. The stock split, of course, took effect. Just want to watch as well, of course, all things from this Apple conference taking place, but I would maybe put this to the fact that you are getting a lot more data coming through supporting the TSMC story within the chipmaker story there as well. Also, a red head coming through right now. This is in Hong Kong as it pertains to another liquidation order from a Hong Kong court. Yvonne, what are you seeing here?
Yeah, this is what we're talking about, Dexin China.
Yep.
So this is what we're hearing so far. We're not getting too many details right now, But basically, they lost this winding up case in Hong Kong today. The firm is receiving the order only 3 months after a petition was filed by China Construction Bank Asia involving a non-payment of some of their notes that were due back in 2022. So this is what we're seeing as the next development here for another property developer. That one just crossing your Bloomberg here this morning as well.
Yeah, okay. So we'll get you more details if we do get more from, but this seems to be the gist of it as well. CATL in focus too. So on Friday you had this big drop there. The markets were close yesterday. I think we're dropping further right now on that stock. Was it Citi?
It was JPMorgan.
JPMorgan, I'm sorry.
I had an interesting note that said basically you should, well, we're not looking at, that's not CATL, is it?
No.
We're looking at something else. But really, when it came to CATL, they said, look, buy the dip.
What was that, though?
Some other ticker.
In case you're curious, it's down.
We're looking at CATL because they said, you know, look, there was some wobbles on Friday that there was like these, I think the Journal came out with some report that, you know, Republican lawmakers want to put this company on some import list or a ban list or something.
Because of labor practices.
Of forced labor practices,
yeah,
right?
Okay.
They've come out and denied, of course, those allegations. But, you know, JPMorgan is basically saying, look, buy the dip because it's unlikely that CATL could actually end up on a list like this. There you go. But there you go. We're still seeing extended declines for that stock this morning.
So 5.7% was the decline on Friday. We're down to further 4% right now. So here's your dip if you want to buy that too. So this is also a very heavily weighted stock on the CSI 300. So where this goes, the CSI 300 goes. On that specific index, we're now down nearly 1% on the CSI 300. On that note, have a look at the benchmarks right now across Greater China. Hong Kong also down about 1.3%. There we go. CSI is down about 0.9%, and MSCI China down about 1.1%. You're getting a bid, though, across the CGB space. Plenty more ahead here on The China Show. This is Bloomberg.
Welcome back to the China Show. Here's a look at the CSI 300 just a half hour into the session, and we come back from that 3-day holiday with some pretty extensive declines here. We're down close to 1% for the CSI 300. I believe Hong Kong is also not doing so well here today. It's really been driven by the likes of tech selling off a bit. CATL, we talked about those wobbles and concerns about whether it's going to be caught in these geopolitical headwinds when it comes to U.S. and China. That seems to be what's really dragging the CSI 300, at least for today, Dave.
Yeah, I mean, I think it's the second biggest stock on the benchmark, and that's actually, so we're down 1.2%. Do we have CATL, guys? If we can we show that too so our viewers can see how much it's down? We were down 5.7% on Friday. Last I checked, we were down about 3.7 to about 4%. This is also, I'll get to this in a moment, about 3.7% about a few minutes back. Okay, we're also looking at a couple of things, right? So Duxin China and also your currency, onshore currencies coming up bottom of your screen. So a couple of things here. There's a broad dollar story coming through from the U.S. jobs report. Yes, we're still talking about that because onshore China is just reopening today. So there is an element of catch up, this gap lower on dollar onshore China. And at these levels, we're now back to the levels, weakest levels here on the CNY, going back to November of last year. I think we have that. Do we have that? Any case, trust me when I say that. There we go. Okay, Duxin China getting a wind-up order out of Hong Kong courts. That's what we know so far in the company. The shares are down 3.3% here in Hong Kong as well. Do we have details on that, please, that we can show our viewers? No? Okay. Anyway, let's move on. Asia, ex-China. There's still a lack of risk appetite out there. That's a good way to put things. We're coming off generally a mixed lead coming out of Wall Street. And the reason I frame it that way is certainly you do have, of course, spots in the U.S. equity market that are doing well. Not all. NVIDIA, of course, still continuing to, I think we saw a further move up in NVIDIA overnight. Let's have a look at the rest of the region, please. Thank you so much. There. Okay, so iron ore and Brent, we're flat on this. Although the Shanghai contract's actually seeing some weakness coming through. So just keep that in mind. Nikkei's up our second straight day. You have the South Korea up 0.5% What you don't see on your screens is the TAIEX index actually moving higher as TSMC also continues to move up as well. Okay, S&P futures, 2-year yield, and the dollar. The reason we're looking at that is going into this inflation report on Wednesday. JPMorgan and Citi are flagging those two risks, right? You have inflation, and then you have the Fed coming through. And then context on how they throw the story forward. in the context of a new dot plot. So if that seems fairly complicated, it is. So JPMorgan's out with their specific game plan on the day. They're attaching these probabilities to inflation coming in at about these ranges, and they're attaching based on, I think, where options are trading at right now, what the likely reaction will be, one-day reaction on the S&P 500. I mean, you simply do the math and you look at really where the probabilities are. The majority, so 25 plus 40 plus 15 plus 5, effectively takes you to what likely will happen, just simply from a normal bell curve perspective. But I think Citi also, Yvonne, has their own game plan set. They think it's going to be quite a big day on the S&P. I think the biggest implied reaction going back to March of 2023.
Yeah, that's according to, of course, their head of U.S. equity trading strategy. And certainly, you know, what would it take for those dots to actually turn and lean a bit more hawkish? It's interesting. You look at the dots from the last meeting where they set those projections, and basically I think it was just a little more than half that did signal 3 rate cuts. Nearly half signaled 2 or fewer. So for us to actually shift to maybe 2 or even 1 doesn't take that much in terms of the hawks among the FOMC. So certainly that's one to watch here. Let's bring in our Bloomberg MLI strategist, Mark Cranfield, with more. We talk about these gaming scenarios. Obviously, we're bracing for this volatility, Mark, but there's still a bit of calm across these markets, right? The VIX is hovering around 13 here right now. How should we be positioned leading up to this Fed meeting and this U.S. inflation print?
Well, it's interesting you bring up the S&P outcomes there from what David was talking about earlier, because actually, if there's a reason for the Fed to be more hawkish than is priced into the markets, it's probably the U.S. equity market, which will give them the window to do that. So there's one thing they really don't need to fear about bringing down the equity. They don't need to be worried that if they were to be slightly more hawkish than expected, they would cause a big disruption across the stock market, because it's so strong it can withstand a little bit of turbulence from the Fed. So if the Fed wants to really mark to market on its dot plots and to be realistic, it should shift to only 1 rate cut this year. That would still give them the optionality of doing something. Because if you look at the jobs data was just so strong last week. It shows the underlying economy is really powering ahead. There's no reason for interest rates to be lowered at this time, and inflation is still not doing what the Fed wants it to do. So the Fed could actually say, yes, now is an ideal window for us to be much more realistic on the outcome for interest rates. We don't really need to worry too much about the stock market. It may go down a couple of %, but it's not going to drop by a huge amount. And the bond market has pretty much started to price in. There's been some steepening as well. So the bond market wouldn't be too shocked. Probably the larger risk to them and to the outside world is really from the US dollar. They could shunt the US dollar quite a bit higher. And that maybe is the one they need to worry about the most.
Yeah, you know, still, I mean, we're, you know, a few days from, about a full week now from what's been happening in Mexico, and yet we're still seeing, Mark, I know you're writing about that too, this EMFX complex. The Mexican peso is still seeing some weakness coming through. And how should we be thinking about the carry at this point in time, given the dollar and given volatility coming back in this basket of currencies, Mark?
Well, the peso in particular, that's a big positioning thing as well. The Mexican peso has been loved by people who do the carry trades. It's been a high yielder for a long time, and there's people who have been getting out of that ahead of the elections in Mexico. So that's partly related to that. But on a broader context, really it's the Japanese yen, which is the big problem for everybody, and for China as well. So dollar yen is very stubbornly high. We're not that far away from the sort of the 160 kind of area. And as we know, the Japanese authorities have intervened, hasn't had a lot of success. If the Bank of Japan this week doesn't do anything, which is certainly something which they, most people are expecting the Bank of Japan to be largely unchanged, maybe reduce bond buying. That's not going to have a big impact on the yen. So dollar yen is probably going to still be in the 157, 158 kind of range. That doesn't help the Chinese currency. It doesn't help the whole EM complex. Upward pressure, dollar against emerging market currencies, it looks like it's going to sustain for some time.
And you're talking about dollar yuan, the renminbi. We could be talking about a higher trading range right now. What are you seeing in there? Mark, can you hear us?
Are you trolling us, Mark?
I think he may have.
Yeah,
I don't think he can hear us. All right.
Yeah, okay.
We'll talk about what that higher trading range for dollar renminbi means for him coming up as well. Mark Cranfield, our MLI strategist, joining us out of Singapore. Still ahead, Apple debuting its long-awaited new AI tools. Going to ask TECHnalysis research chief Bob O'Donnell for his take. We'll also be hearing from Apple co-founder Steve Wozniak on what he wants to see out of those new AI features. This is Bloomberg.
Right, all the way to the 30 years, so just about a glance at the curve right now. So we are seeing some gains here, and yields are down about 1 to 2, just about across the curve. It's quiet. A lot of event risk on the table. We certainly have seen a melt up from Friday's session, just about across the curve as well. And we'll see, really. A lot will depend on two key events, of course, on Wednesday, our time. Wednesday and Thursday morning, our time.
Yeah, it's all happening in one day, right? Which people are saying is probably one of the biggest market events we've seen maybe about a year or so. So certainly, we talked about what these trading hubs trading firms like JPMorgan and Citi are really kind of game planning here right now, certainly when it comes to what it means for the S&P. But certainly, we've seen a lot of that reaction already in this bond market.
Yeah, well, let's see whether bond markets are getting this one on the dot. There we go. No pun intended there. Carlos Casanova is here with us, senior Asia economist at UBP. So, what do you think the dots are going to show? Do you think bonds are now fairly priced given the rate expectations? Sorry, let me rephrase that.
Our target for the 10-year is still 4.5%. So we think that there's a little bit of upside still left to the 10-year yield. Of course, a lot of that could come from a surprise on the dots this week. Yeah. I think the consensus is the Fed will move immediately, but we could see a revision to the dot plots, pointing to fewer interest rate cuts. We currently expect one in December, but of course a confirmation of that or even no rate cuts could move the markets quite significantly. Primarily, I think the reason behind this is that we are seeing this inflationary process that was very strong throughout the whole of last year stagnate completely, even reverse slightly this year. And that is the main thing that the Fed's using to justify rate cuts. Inflation below 3%, converging towards 2%. Inflation is going to remain above 3% this year, and they don't have enough ammunition on the labor front to justify an earlier pivot. So we are still wait-and-see mode. And so we do think that the most likely scenario is a revision in dot plots and a rate cut in December.
So from what we saw from Bank of Canada, ECB, I mean, are those just going to be anomalies? Because you still think maybe central banks, they need to take action to drive that last leg of disinflation further? Or can they actually cut before reaching target for inflation?
I think we are looking at a much more diversified picture across the world. Central banks in Europe are going to be able to decouple from the US Fed to some extent. We are seeing that with ECB. There's some uncertainty in Europe after that European parliamentary election. So possibly the pace of future rate cuts will be slower than the market is pricing in. But we do also expect the Bank of England to start cutting rates after the election. And because they will delay the start, they will be much more aggressive than ECB. So I think in Europe, there's definitely scope to decouple from the Fed. In Asia, unfortunately, our monetary policies in most cases remain sort of dependent on that Fed pivot taking place at some point in 2024. So for the most part, we're going to see fairly wait-and-see modes across the board in Asia.
So who in Asia would now not be able to cut interest rates because of this December call on the Fed, for example?
So I think of the major central banks that we follow, the two key ones that are a bit stuck are Australia. We are seeing growth momentum remaining very sluggish. A lot of that is linked to higher borrowing costs. The proportion of household debt that's linked to mortgages in Australia is amongst the highest in the world. So households are struggling with higher debt servicing costs as a result of rate hikes. hikes, but the RBA won't be in a position to do much on the cutting side until we see a pivot from the Fed and some disinflation. The other central bank is India. We were hoping that they would support consumption after the election through rate cuts, but it looks like the Reserve Bank of India might have to hold on until the first quarter of 2025. So we could see a slight deceleration in momentum over the next few months in India, although it's still one of the fastest economies in the region, but they're also waiting for the Fed. In terms of who can move, PBOC and Bank of Japan.
Okay, but those are idiosyncratic reasons really for those.
Correct.
Just a follow-up on India, because there's also the bond inclusion, and that's really attracted a lot of inflows into the market. On the RBI, do you think they have to do more? Have they done enough to stabilize the currency? Do they need to do more on the FX front?
I think that India is exposed to fluctuations in the US 10-year yield. We are seeing that fueling depreciation across the board in Asia, and especially with our target being 4.5, a little bit of depreciation remains a risk factor for this year. I think that the main thing that's going to help the RBI is structural reforms that aim to reduce volatility in food prices. So you have export curbs. They've been doing a lot to stabilize food price inflation. So any overshoot over the next few months, potentially we'll see that overshoot taking place this week, will be short-lived and so won't derail the RBI.
You mentioned about why these central banks are delaying. I mean, how much does it have to do with what we're going to see in the dollar? I think consensus still thinks that in the second half we're going to see a weaker dollar. That seems to be kind of fading now. These calls, we're testing to year-to-date highs for the dollar here right now. Is there further upside? What does the macro data tell you?
So assuming move up in 10-year yields, we still see that rate differential with Asian countries remaining quite wide for the rest of the year. So we think that there is a moderate upside for the dollar and very limited sort of downside. So meaning that the room for Asian currencies to appreciate meaningfully against the US dollar in the absence of an aggressive rate cutting cycle is very low. So that's going to inevitably keep central banks on their toes and complicate their visibility regards their outlook going forward.
What's the next major move, or what are the next major moves and when from the BOJ and the PBOC?
So BOJ, this meeting this week is interesting. It's expected to be a non-event in the sense that Bank of Japan will not move, but I think the underlying dynamics are quite interesting. So if they announce changes to the Japanese government bond yield, that could materially move the market. We have seen since they abandoned yield curve control, the 10-year yield actually move above 1%. Equilibrium level for JJBs are about 1.2. So that move up in JJBs could have implications for global markets and could fuel some reshoring of offshore Japanese assets back into Japan. So I think that is quite interesting to monitor. Moreover, we still think they don't have enough visibility on the wages front, but there's a lot of rumors in the market now that Ueda might start to prep everybody for a sooner July rate cut. Now here's the catch. It doesn't matter whether Bank of Japan does 10 basis points or 20 basis points, that rate differential with the US is almost 5%. Yeah. So it won't really substantially change the structural factors that are driving that yen depreciation. But it's nonetheless, it could move on the equity front.
Yeah, so we're seeing a yen still at 157 levels. I'm wondering then about the currency. How important is that going to be a factor in whether they actually hike or not now? I mean, is this a bigger priority in setting policy?
No, I 100% think that that's the case. We're starting to see some voices within the Monetary Policy Committee that argue that sharp yen depreciation poses more risks for the outlook than moderately higher borrowing costs. Yeah. So, 20 basis points versus the yen going above 160, they would rather get on with it and do more sooner. But as I mentioned earlier, ultimately the Bank of Japan would have to undergo such an aggressive rate hiking cycle to offset the structural factors. I don't think they're able to go there, and so I think that fundamentally the yen will remain under pressure.
Can we say the same about the Chinese currency?
Of course, at JPY over 160, the PBOC has a really difficult time ensuring that their exchange rate against the US dollar remains balanced. Of course, the Chinese currency is very expensive against other regional peers.
That's true.
So we do think that that is one of the policy tools that they have at their disposal, but they are not able to do it sneakily through higher rate fixings. The PBOC would have to announce a rebalancing of the currency of baskets that underpins the exchange rate regime away from the US dollar towards some of the new trade partners. And of course, in case we did see a devaluation of the yuan, that would fuel outflows, and it would be fairly negative for Chinese equities, in my opinion.
That's not your base case, is it? Or is that your base case? Like, at some point, do we need to have the conversation?
At some point, we need to have the conversation. Okay. I think it would benefit longer term. I think currently, and in the new environment of high for longer, supporting the yen at 720, 730, the yuan at 720, 730 doesn't really help PBOC. I think some short-term outflow risks would be offset by having more flexibility on the monetary front. They're not really worried about the depreciation so much. They're concerned that the current regime is restricting them from delivering monetary policy support. So if we do see a stabilization of the housing sector in the second half, that means the demand will be there. So they can cut interest rates and the demand will be there. At that point in time, I think it will be interesting to have a conversation about whether or not it makes sense to devalue the Chinese currency.
All right, Carlos, great to have you. Carlos Casanova there, Senior Asia Economist at UBP. We got plenty more ahead. This is Bloomberg.
All right, welcome back. You're watching the China Show. Live pictures out of Singapore, where you can probably guess what the weather and humidity are like at this point in time. Little variance there. Equity market, a third of 1% to the downside. Okay, now Bloomberg has, and more there's this Bloomberg story out today. We'll talk more about it, in fact, right now. So we've learned that the authorities in Singapore are ramping up scrutiny of family offices and hedge funds. Now they're seeking more information from the investment firms after the string of scandals. Avril Hong, our Bloomberg reporter, is with us out of Singapore to tell us. Let's start with the basics. What do we know, Avril?
Yeah, after a string of scandals, including at least one of the men involved in this massive money laundering scandal that hit the city-state, known to have links to family offices that were granted tax exemptions, authorities essentially are stepping up oversight. And we are hearing from some of the people familiar with the matter that our Bloomberg newsroom colleagues have been speaking to, that family offices are essentially being asked to furnish further details. They've been given forms that they have to submit by the end of the month, and essentially they have to confirm that their owners, directors, shareholders don't have any links to money laundering or terrorism financing. They haven't committed offenses or been charged with such offenses. They also have to show that, they haven't been investigated in a way outside of Singapore, faced regulatory action even outside of the country. And the idea here really is for there to be greater data in order for authorities to be able to kind of spot undesirable activities sooner rather than later. And it's all part of this push that has accelerated since March. Authorities just stepping up oversight here.
Yeah, and what else are authorities doing to deepen that oversight now too, Avril?
Yeah, we've heard the Singapore regulator MAS confirming in March that it's basically going to be scrapping one of the licensing categories that hedge funds have used since 2012. They're going to migrate it to one with stricter restrictions, accounting authorities. They've also reportedly been speaking to directors of inactive firms. The idea here is to shut down some of the dormant firms so that they can't be used for illicit activities. So a lot of developments in that regard. Some have said that these tighter rules and oversight might actually add to costs for these smaller firms that are trying to do business in Singapore. But again, the idea here is for there to be greater data, tighten some of the oversight, close the loopholes, and hopefully prevent some of the risks of illicit activities in the Lion City. Guys.
All right. Avril, thank you, Avril Hong there with that update from Singapore. And some other stories that we're tracking for you today. The UN Security Council has adopted a U.S.-crafted resolution endorsing Washington's ceasefire plan for the Israel-Hamas war. The resolution passed 14-0 with Russia abstaining. Hamas has welcomed the adoption of the resolution and says is ready to cooperate with mediators. But Israel says it will not engage in meaningless, endless negotiations that could be exploited by the militant group. Russian President Vladimir Putin is reportedly set to visit North Korea and Vietnam soon. That's according to a Russian newspaper, which did not give firm dates. If true, this would mark Putin's first visit to North Korea since July of 2000. Both leaders met in Russia last year, mind you, and the new visit could stoke fresh concerns from the U.S. and its allies over Russian aid to North Korea in exchange for arms.
Okay, well, looking at EV stocks first and foremost, and within the EV stocks, of course, there's also the CATL story, which is separate. Let me start off with CATL. So we're down a further 5% today, down 5 or 6% on Friday. It's still the same story on this import, concerns over an import ban. And JPMorgan says, Yvonne was reminding us earlier, to buy this dip. The risk of CATL being subject to that ban is low, and the stock's drop presents as buying opportunity. That's according to one of the analysts at JPMorgan. Of course, speaking of import ban, tariffs are on the agenda this week, and we'll really see to what extent those tariffs will go up in the EU. Hence, we're watching some of these EV plays there as well. RoboSense up 60% here in Hong Kong after the Shenzhen Stock Exchange said it would be eligible for the Stock Connect inclusion in the program. There we go. That's what inclusion does in more ways than one. This is Bloomberg.
All right, 11:29 a.m. in Tokyo. Looks like Japanese markets are heading to that lunch break on still a slightly better note than, relatively speaking, from the rest of the region here. We're up about 1/3 for the Nikkei 225. Dollar yen, we're still on the weaker side here, 157 levels as we approach that BOJ meeting, and yields are ticking lower by about 1 basis point, but we're still talking about 1.03 here right now.
Yeah. It's probably the weekend story that's playing a part there. Asia ex Japan on price, we're down 0.6 of 1%. On volumes, we're slightly on the lighter side of things. If we can get that up, please, if we can here in terms of sector groups as well. So some of the rate-sensitive sectors are dragging on this index. Recession lows on the benchmark itself. Oh, there we go. Okay, on your screens. What else do we have here? So weakness coming through in Asian FX. So the strong dollar story is still playing out. And really what you don't see, like big movers like CATL, which is playing a very big part to the drag we're seeing, the points drag here in Hong Kong, that's also helping drag some of these other benchmarks. But yeah, it's risk averse out there, looking at this broad, the negative breath we're seeing here across the equity market.
Yeah, and part of that maybe had to do with what we saw with Apple overnight as well. So they unveiled this long-awaited new artificial intelligence features, including tools supported by OpenAI's ChatGPT. So confirming this earlier Bloomberg report of this tie-up. We saw the Apple shares were down on this, quote, disappointment from some of the analysts out there. Maybe it was just kind of in line on what they were expecting. The Apple suppliers are doing this year. It's a mixed bag, but mostly lower. So still feeling a bit of disappointment there. We did hear from the Apple co-founder, Steve Wozniak. He told us exclusively that he's impressed with the firm's AI offerings, but he also says the success of the products will be up to consumers.
Still believe strongly you should try it and find out after it's over, you know, what works, what doesn't, what didn't come through the way you expected it to. Especially I'm afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. But all the demos today were pretty much, you had a choice to circle some little area and let it go and do its magical wonders, or rewrite something, and you chose to do it, what it was supposed to do. And that means you're looking at the result and determining as a human, how does that make it work? So this is one more type of AI, Apple Intelligence. I have AI myself, actual intelligence.
Okay. All right. Well, we're going to patent that one here. So how does your actual intelligence then fold in with the technology here? Because once the developers sort of really sink their teeth into this and we start to see this roll out, what do you really sort of envision as being the practical application, and not just for the tech geeks out there, but for maybe some of those folks who maybe aren't as tech savvy, but have seen all this hype around AI over the past couple of years and want to know how they can use it or how it's going to factor into their life?
Sure. Well, in using my products, mainly iPhones, but I also use Androids, it's like I want to say something. I know the information is in here, and I may have to go search for a certain picture or this and that, have to do a lot of stuff manually, and it sure makes it seem like a lot of that's going to happen automatically, exactly what you want. When you often ask Siri to do something, if it's a very simple statement, Siri knows how to do it, good. If you ask something that any human being would understand, but slightly complicated, one extra word, Siri sometimes have trouble with it, so I'm hoping to see that finally improve, because I like using Siri an awful lot.
Do you think,
so I want to see a big improvement.
Okay, there we go. Steve Wozniak, Apple co-founder, speaking exclusively with our colleagues, of course, remain Bostic and Alex Steele, outlining, of course, his actual intelligence. Okay, let's get instant, actual, intelligent analysis right now. Bob O'Donnell joins us, President and Chief Analyst at TECHnalysis Features. Bob, good morning from the Asia Pacific. Thank you so much for joining us today. Just let's start off. Your initial take on what Apple laid out. Impressive or not?
Well, look, I think what they laid out was a very good story. I mean, Apple's incredibly good at weaving a story together around technology. I mean, it wasn't cutting-edge stuff. There are some people doing more advanced stuff. But I think it was enough to get people intrigued. And so I think that's important because, remember, when it comes to Apple, the number of people who use their products worldwide is so enormous that they're going to actually introduce a lot of people to Gen AI. We've been talking about Gen AI in the industry a lot, but in reality, most average people haven't really experienced it yet. And so I think what you're going to see with these Apple Intelligence features when they start shipping in the fall is that people are going to go, wow, actually, now I kind of get it, and this is kind of cool. Now, it's not going to work for everybody, and there are some issues, but like Steve said, it's, automatically doing certain things is really going to make your device feel smarter. And at the end of the day, that's important because Siri and other digital assistants have been incredibly frustrating. So to be able to just say something and have it react and have it turn on certain features or functions, I think people are going to enjoy that.
So are these software features then cutting edge enough, Bob, to really kick off an iPhone upgrade cycle?
Yeah, so Yvonne, I mean, that's the big question, of course, is it enough to really get people to buy upgrades? And of course, Apple, unlike what we saw with Samsung, who, for example, brought AI features not only to their newest phones, but 2 generations back, Apple said, only 15 Pro, and then certain Macs, and then the future iPhones are going to be required for this. So the expectation is that some people will buy it. I think some will. The thing that surprised me the most, though, to be honest with you, is how much credit, in fact, they kind of gave to OpenAI. I mean, some people kind of joked, all of a sudden, Siri is a front end to ChatGPT, and that seems a little un-Apple-like, right? I mean, this is a company that's controlled the experience, and all of a sudden, they're like, oh, yeah. I mean, of course, they say, is it okay if we use ChatGPT? People are going to get tired of doing that. They're going to turn that off. They're just going to use it. And then what happens if something weird happens with OpenAI? Because let's be honest, weird things have already happened with OpenAI. And does Apple's experience get impacted from that? Now, after the fact, they did a Q&A with the press that said, hey, look, yes, we're also going to let Google models work, potentially others down the road. But still, it clearly showed to me that Apple didn't really have their act together to do the full set of intelligence that they wanted to do, and they had to rely on partners. Again, not very Apple-like, perhaps why the market reacted the way it did.
Which brings to mind, Bob, whether or not this really is or not, their area of expertise. The reason I bring that up is, the share price is flat year to date, down massively. It's come back all the way effectively flat. And the markets treated Apple not like an AI play. And I'm wondering whether they've said enough for markets to then treat it like an AI stock, like the others, of course.
Yeah, no, it's a great question, David. I'm not sure that they did enough, but at the same time, look, again, we got to remember, like I said, that their impact is enormous. And I think really what they're going to do is sort of set the stage for a broader Gen AI usage across more and more devices, because people will be introduced to it. They're going to see it can do some pretty cool stuff. And then they're going to say, okay, now I get it, I understand it, and I can appreciate the value. And look, some of the demos they gave were pretty darn cool. They don't apply to everybody, like I said, but they apply, I think, to enough people that it's going to be important. And the other thing, here's the other thing to remember with Apple stuff. Sometimes it's the dumb little features that people really like the custom emojis. You know, it could be that every 20-something in the world goes, I got to have custom emojis, so that's it. I'm going to do it because of that, right? And quite honestly, the other thing they're doing is they're bringing RCS to the iPhone, all iPhones, which means texting between Android phones and Apple phones. If you've ever had that experience, photo quality is terrible, video quality is terrible. That has nothing to do with Gen AI. That's going to work. It's going to be better. You're still going to have green bubbles, but you'll get a better quality texting experience. And frankly, for some people, that'll be more important than all of this other stuff.
Yeah, as you say, it's the stupid, silly stuff. But that can change our lives. What about what Elon Musk said? I mean, he's threatening to ban iPhones in his companies because of this ChatGPT partnership that Apple has gone upon. Are the security risks warranted in any way, Bob?
You know, I don't think they are. I think this is, classic Elon Musk posturing. And of course, he's still upset about not really controlling OpenAI, even though he started it. I think there's a lot of personal grudges going on there, to be honest with you. But look, I mean, Apple made it very clear they're going to do a lot of these capabilities on the device, on the phone, which we've heard other companies talk about as well, and then do some of it in the cloud. The difference being they're going to do it in their own cloud, Apple's own cloud, on Apple Silicon-based servers. It's actually existing Mac-based processors from the Mac Pro that they're going to put into these servers, and they're going to do it. And then the ChatGPT stuff, well, that's ChatGPT. But I think this is just, again, a reflection that Apple has opened themselves up with this OpenAI collaboration to those kinds of questions and those kinds of risks. I don't think the Musk thing is a serious concern. I think Apple's doing a pretty good job, as they always do, around security and privacy. But at the same time, it's just enough to make a couple of people say, okay. And that's the big issue. It may not be reality, but it raises the question and the concern, and people start thinking that way.
And Bob, looking perhaps longer term, and just to bring in the Bill Gates quote, that we tend to, I think, just to paraphrase, we tend to overestimate the short term, 2 years. We underestimate, the 8-10 years beyond that on things like new technology, I believe AI, for example. In the same breath, do you think we are currently, and let's say Apple is entering something new here, are we underestimating the revenue boost further down the road for Apple here?
Well, that is the ultimate $64,000 question, of course. And I think it is, because I do think, as I said, what Apple's doing is enough to get a lot of people to recognize, wow, there's a lot of capabilities here. It's enough to get developers to start thinking differently about, hey, I have a big audience I can start reaching out to, start coming up with new ideas. Now, of course, initially, Apple said this is all for free. And of course, even the ChatGPT access, it doesn't cost you any money if you don't want to pay for it. But you have to imagine down the road, yes, Apple's going to figure out how to monetize some of these services, and it's going to add to that services pot. And look, what it does help do, David, is address the fact that people are the basic iPhone. Nobody cares what it looks like anymore. They don't care about the new features. But if all of a sudden I need a certain phone to do certain functions, okay, now all of a sudden it gives me a reason to upgrade that I didn't necessarily have. And I'm pretty sure that's what Apple's counting on.
Bob, always good to have you. Thanks for staying up for us. Bob O'Donnell, President and Chief Analyst at TECHnalysis Research. We got plenty more ahead. This is Bloomberg.
Oh my goodness. I hope you have your umbrellas out, or your cheap shoes, or you're working from home, or you're taking the week off like most people because of Dragon Boat, or watching us today. Certainly the clouds of Mordor are hanging above one of the twin towers in the city. 2 towers, I should say. Let's get to the news of Hong Kong today. Big one, of course, this week is, Hong Kong's top court is losing a third overseas judge as scrutiny rises over the city's judicial system. Canada's Beverly McLaughlin says she will retire from the Court of Final Appeal when her term ends on July 29. Now, her exit follows the departures last week of two of her peers, with one of them saying in the FT that the rule of law in Hong Kong has been profoundly compromised.
Yeah, in that article for the Financial Times, Jonathan Sumption also says that Hong Kong is slowly becoming, quote, a totalitarian state. For more, our Asia government and economy correspondent Rebecca Chung-Wilkins is with us. Can you tell us a bit more why these three judges have resigned?
Yeah, something of a blow, at least to the perception of Hong Kong and rule of law here. Lord Sumption's op-ed in the FT that you mentioned is probably the sort of clearest explanation. And he talks not just about those concerns of the quote-unquote totalitarian state, but also this malaise that is hanging over rule of law in Hong Kong. And he talks with sort of quite a level of detail over some of the judges and the pressures that they face. That, although local judges, of course, he sort of gives them benefit of the doubt in the sense of sort of praising their desire to act independently. But he talks about the difficulty for local judges to continue operating in an environment where they're being repeatedly called to make patriotic judicial decisions, as well as some of the sort of criticism when they have shown some leniency, when they have, for example, acquitted people or granted people bail in relation to national security cases, the criticism that they face. So he lays out in quite a detailed way this sort of backdrop for judges, not just sort of for the Court of Final Appeal, but judges in the city at large.
I think the Hong Kong chief executive, John Lee, was chimed in on this issue during this weekly press briefing just a couple of minutes back. I want to play it out for our viewers to see, and then we'll talk about it after. Let's play it out, guys.
Judges' professional expertise is on law, based on his legal knowledge and experience. Judges' professional expertise is not on politics. A judge can like a particular system or dislike it. He may also like a particular law or not. But his professional duty is to interpret and apply that particular piece of law in accordance with legal principles and evidence.
So I guess the big picture question there, what does this mean for the rule of law?
Well, it's important to say, as we point out, that John Lee has rebuffed these criticisms very, very firmly. And it's something that the government takes very seriously, because they have repeatedly in the past touted the benefits of Hong Kong's system, rule of law, independent judiciary, as well as specifically this benefit of having overseas judges. So the fact that we have just a handful now, does somewhat dent the case, not least because it's accompanied by very direct criticism over what's happening to rule of law. So certainly we should expect to see more scrutiny. And I think there will be some sort of feeling as well and some worry about what happens to the Court of Final Appeal. There has been, in private conversations that I've had with lawyers and so on behind the scenes, there has been some optimism that the Court of Final Appeal is really still a robust sort of last wall, last defender. Now, of course, it's worth saying that it's feasible that Beijing, if they didn't like a decision by the Court of Final Appeal, could come in and overrule. But there was still some confidence that the Court of Final Appeal would be there as a sort of last protector of some of the issues that critics of Hong Kong have raised time and time again. So that confidence, that's specifically what I would expect to sort of be somewhat dented, somewhat questioned now.
Rebecca Chung-Wilkins, thank you so much on all the latest on that specific story. Let's stay in Hong Kong here. So the deepening property slump in the city is about to reach its 5-year mark, the longest streak of declines in the property sector. You have to go all the way back to the SARS crisis back about 2003, if I'm not mistaken, about 2 decades ago. So BI, Bloomberg Intelligence estimates at least $270 billion has been erased from real estate values here in the city since 2019. Our Asia investing editor, Russell Ward, joins us right now for more. Yeah, and Russell, what makes this current slump different from what we've seen in earlier downturns here in Hong Kong?
Morning, David. Yes, I mean, it's natural for any city or any country to have a property downturn. Hong Kong's had downturns in the past with the property market, as you mentioned, the SARS based problems that they had years ago, but you know the market's always bounced back. It's been regarded as being unsinkable, but this time around, the crisis, the property slump, was triggered by the pro-democracy protests a few years ago, and then obviously worsened with the COVID restrictions that prompted sort of an exodus of people from the city, and then got even worse when the Fed raised interest rates, and of course the Hong Kong dollar's peg to the US dollar really hit it where it hurt for the property market here. So really, you know, those were the causes, but looking, you know, sort of more deeply, I think the slump really reflects sort of a lack of confidence in the future for Hong Kong, basically, as a financial hub. Earlier in the show, you mentioned, you know, there are questions over the rule of law. That's a very, very important part underpinning any financial hub. And then, you know, you've got the issues with the security law. Sort of just the sentiment generally on the ground is pretty bad. So, you know, home prices on Hong Kong Island have slumped 29% from a high in 2019. So, you know, and one analyst we quoted in the story said that the era of rising prices is over. So, you know, it's looking pretty bleak.
Yeah, it's interesting, too, because the government did try to revive this market. They scrapped stamp duties early this year. They scrapped basically almost all of these curbs as well. And still, you're seeing this sort of gloom. Maybe because mortgage rates, as you say, are still high. So in face of all that, I mean, are we still seeing any signs of bright signs in this gloom right now, Russell?
Yeah, I think you mentioned rising interest rates. I mean, they're not going to be, you know, at some point rates are going to go down. Of course, there are big questions over when the Fed will eventually cut rates. But then if you just look, and then I suppose looking at the other side of the coin from rising prices, from falling prices, is that the Hong Kong the property market has become more affordable. Obviously, Hong Kong's property market is notoriously unaffordable, and so, you know, that is one bright sign for prospective home buyers. But the other side of that, of course, is that, you know, property is no longer the store of value that it had been in the past, and it sort of reflects the same sort of problem that we're seeing north of the border in mainland China as well. The property is undergoing a severe correction there. Housing is becoming more affordable, but really as a store of value, there are big questions over that. And so, you know, there are big questions going forward about, you know, the prospects for the property market in Hong Kong and in Greater China.
Russell, thank you, Russell Ward there, our Asia investing editor, on the latest when it comes to the outlook for the Hong Kong property market. Coming up next, we're going to have the latest spending numbers from the 3-day Dragon Boat holiday that just wrapped up here in Hong Kong and in China. But not everything is smooth sailing. Your China Brief is next. Well, here's your China Brief. A look at what's making headlines in national newspapers. The 3-day Dragon Boat holiday wrapped up in China. It's estimated that domestic tourism, those numbers coming out, rose over 8% on year. 110 million tourist trips were also recorded during the holiday, which was a jump of about 6.3%. And meanwhile, estimated that the total holiday box office will also top 403 million yuan. But that performance wasn't as strong as expected. The record haul from moviegoers during a Dragon Boat holiday was about 900 million back in 2018, RMB-wise.
Yeah, so I think it's important to do a like-for-like comparison at this point, right? I think Citi crunched the numbers on this.
They still think it's a bit weak.
It's a bit weak.
Yeah.
I think they put out a number, 12.3% below the 2019 level, and they're citing average spending per traveler, so we're about an eighth lower. We're getting some market reaction across some of these names here in the city. So yeah, I mean, we're certainly up year on year, but compared to where they should be normally speaking,
yeah,
if that is a good comparison to make, we're still not there just yet. But also keep in mind, you know, inflation is. It was a very low inflation environment, and you have travel discounts and the like, so that might be also.
And they're going to lower tier cities, which is sort of the trend now, and spending cautiously there as well. There's a lot of discounted packages out there. Yeah. So certainly maybe that just goes to show things are still looking pretty tepid here right now. You take a look at what markets are looking at, pretty tepid as well today.
In the absence of good news or anything, people just blindly close their eyes and go AI, right? TSMC, reason I say that, 1.7% to the upside amidst really what is, broadly speaking, a sea of red across most sectors. Gold miner stocks on your screens as well should be seeing some downside there as well, in the order of about 6 to 9%, just about across the region. That's it from us here on the China Show. Bloomberg Markets Asia is next. This is Bloomberg.